My name is Peter Gardner. I'm a certified financial planner practitioner and a retirement income certified professional. However, I am not a CPA. I do not prepare tax returns either. So before I jump into the slide that we're looking at here, please be sure to check any of the possible scenarios that we're talking about with your accountant and or team of financial professionals as well. We are looking at this from a financial planning point of view here as we move forward as well. But when it comes to tax deductions, and guys, we already covered a lot of the items that I will go in a little bit more of a detail, but really we're just scratching the surface. So I will highly encourage anybody that is picking up ideas, gets excited about some of the ways that you might have known, maybe you were not in the right position, it wasn't the right time, or maybe there's a spark of something new that you learned about. Please reach out to Justin and the team, and they'd love to have that conversation for everybody as well. Now let's start with tax deduction. Let's start with the easy ones, reducing current year taxes. Well, for 2021, if you're filing married, filing jointly, that's about a $600 deduction. If you file a single return, $300. That is available even if you do take the standard deduction and do not itemize. So this is one way that could help lower your AGI. Again, a lot of the things should be discussed as part of an overall financial strategy. It's possible that as you move up the career ladder with your degree from DSU, you start earning more and more money. That's a good problem to have, right? But it's also equally important to consider and manage the tax situation as well. And if there's ever a win-win, it is something that we should all probably look at as well. Now, when it comes to carryover contributions, well, you might not be able to deduct it in the current tax year because it may exceed your adjusted gross income. But just know that you could potentially deduct the excess in each of the next 5 years as well, until it's used up as well. Lowering taxes on income, we'll touch some of the other ways here as well. They were a little bit described earlier, maybe without using the proper the textbook words for them. The charitable gift annuity. Well, simply put, it's an arrangement between a donor and a nonprofit organization such as the DSU endowment, which the donor receives a regular payment for life based on the value of assets transferred to the organization. Now, at the donor's death, the assets are simply retained by the organization. Again, it's one way or a possibility to create a win-win for everybody involved here as well. The charitable remainder trust is a tax-exempt irrevocable trust that's designed to reduce the taxable income of individuals by first dispersing income to the beneficiaries of the trust for a specified period of time and then donating the remainder of the trust to the designated charity. So depending on whether you're looking for 1 year a larger tax deduction or maybe something that's a little bit more tax efficient for future years, that is a conversation. There are different really solutions available as well. When it comes to reducing tax on appreciated assets, well, we talked a little bit about, and again, by no means are we making any kind of stock recommendations, but we talked about Home Depot earlier, among other things, and you talked about your specific company stock, right? Anytime you are dealing, whether it is you bought the Home Depot shares for $4.50 or you received stock for low or no cost basis, maybe you were able to buy into company shares at a discount, anything like that. A low basis investment of what you really purchase or receive these investments for, well, you can consider donating part or all of those, of course, to a charity via gifting. It's simply put a free delivery of these funds to the charity. Again, it will likely cost you less because you don't have to pay the capital gains, but the charity receives the full amount. They receive the shares. Of course, they can sell them right away and not pay taxes on that either. So that could be a way for some people as well if they're specifically tied up in one individual stock. I'm a big fan of diversifying assets anyway, so if that's an opportunity to create that as well, even better. Real estate gifting, we talked a little bit about the ownership, but you could, of course, also avoid paying capital gains when a property would otherwise be sold. That's another way to look at it. And again, it depends on, of course, your priorities and what role this could play for you. We briefly touched on IRA required minimum distribution just as a to take a step back really quickly. Well, the current rules, right? Any kind of retirement account, IRA, 401ks, 403bs, once you're age 72, right? That just recently changed from 70.5 to 72. You'll have to start taking out a minimum amount every year. That's a good and a bad problem. for you to have. It depends on what kind of taxes you would pay on that otherwise. However, if you're already charitably inclined, Dr. Das mentioned the QCDs, which is a qualified charitable distribution. The rules are a little bit different. They're grandfathered in. You only have to be 70.5. And it's one way, if you already have a successful financial strategy and plan in place, where each individual that has, let's call it, a collection of IRAs, of course, 401ks, 403bs, we could certainly give up to $100,000 a year to a charity without having to pay taxes. Now, you don't get a tax deduction, right? But it's also not part of your income. If your RMD is $5,000, $10,000, $20,000, well, you could give up to that amount. And you would also satisfy your RMD at the same time. So that could be another win-win scenario. That's a conversation I have with a lot of my clients that are already retired, but it has to make sense. It's certainly, none of these strategies is always the right fit for everybody, but it's important to have at least the conversation and to be aware of all the different possibilities as well. Now, the last point here, well, reducing estate tax liabilities, well, the estate taxes are not a big deal right now. But as you know, tax laws and other regulations keep evolving and changing. One way to potentially have a tax benefit indirectly would be to list charities as beneficiaries on IRAs, 401ks, right? Pre-tax retirement accounts. As you know, the rules also changed, end of 2019. Now, let's say you have your children listed as beneficiaries. Well, depending on their income, they have to take required minimum distributions at some point out of these accounts, given certain exceptions, and they pay their own tax rates in their own tax brackets based on that income on top of it. So it would be no big deal if they are starting out early or they're unemployed. It would be a big deal if they're in their highest earning years. So it's one way, again, to maximize the value that a charity could receive here. And of course, there are other ways to plan around it to make sure that the family is also not left behind either. But again, like I said before, any of these strategies, please, please, please consult with your tax professional prior to taking any actions as well. We just want to educate you a little bit on those, on all the different available options for you. With that, we can probably jump to the next slide here, Justin. I'll give you one example here, and thanks for preparing that, Justin. Let's talk a little bit about two different ways how appreciated assets could make better gifts than cash. So we're looking here at somebody, just to spell out the crux of things, in a 37% tax bracket. Well, so that's an individual that is earning well over $500,000 a year, right? Now, if that person was to simply write a check to DSU for $10,000, well, in this first example here, they could take the deduction to 37% from their taxes, and it would basically, and I'm oversimplifying a little bit, but it would basically cost them $6,300. Now, DSU receives, right, the $10,000, and really it'll cost them a lot less. So it's a good starting point. But I always like to challenge everybody and ask, isn't there something else we could have done? Isn't there something better? Well, of course there is, right? In the second scenario here underneath, and this is sort of going back, let's call it the Home Depot example from earlier. And again, we're not making any kind of recommendations by any means. But assuming that this hypothetical $500,000 earner here has stocks in his investment account that have appreciated in value, right? That are a whole lot more worth than what he paid for them or received them for, he could donate these appreciated stocks to DSU instead, while still looking to give a quantity of shares that's roughly $10,000. Now, not only would he receive the income tax deduction of the $3,700 from the previous example, but he also avoids having to pay capital gains. For him, that's 20% plus another 3.8% additional taxes on top of that because of his income. So if we give this some thought here, right, and all of the stars, of course, as always, align, that same $10,000 donation to DSU could be costing somebody just a little bit over $4,000. And again, we're simply showing you this to share some of these options with you. And again, I always want to make sure that it makes sense as part of an overall strategy. Your team of financial professionals and of course at Delaware State are happy to discuss and answer any questions that you may have. So hopefully some of these ideas resonate with you.